For active day traders, the steepest drawdowns rarely occur during major trend reversals. The heaviest capital decay happens during periods of aggressive, non-directional whipsawing. Traders try to apply standard breakout and breakdown strategies to a sideways market, only to watch their positions immediately fail in both directions. This chart shows the exact mechanics of that decay. A trader will see a green candle push the upper boundary, trigger long, and immediately take a stop loss on the reversal. They flip short on the ensuing breakdown, only to be stopped out again as the tape rips higher. The typical retail trader walks away from this sequence blaming bad luck, claiming the market is manipulated, or convinced that stop hunting algorithms targeted their exact entry. In institutional trading desks, we view this entirely differently. These hostile environments are predictable, and the trader's confusion is the result of a specific structural blind spot. The flaw is single time frame bias. Staring exclusively at a 5-minute candlestick isolates a single thread of data and ignores the broader mechanics driving the tape. Intraday price action is a composite vector. It is the real-time collision of multiple institutional cohorts, all operating on different higher timeframes, simultaneously defending their own levels. Looking back at this same chart, we can reveal the underlying architecture. The chaotic price action is centered perfectly across a dense knot of conflicting moving averages. We call this knotted structure the mixed blender state. Sideways chop is mathematical multi-timeframe desynchronization. The market has lost its directional vector because the short-term, intermediate, and long-term participants are pulling against one another. To survive and exploit this, we must map these conflicting layers of institutional gravity using the intraday multi-timeframe mean matrix. Shifting your process from analyzing isolated 5-minute patterns to tracking multi-timeframe structural alignment removes the element of guesswork from your execution. This chart begins as a blank execution grid, wiped clear of retail indicators, to build the mean matrix from first principles. The first layer is the 15-minute 8 exponential moving average. This is the short-term momentum highway. This fast-moving layer tracks the ultra-fast attack algorithms that dominate the tape during an aggressive opening range breakout. As long as price prints above this lime line, fast money controls the trend. Below that highway, we map layer 2, the 30-minute 21 EMA. This acts as the intraday fair value line. Fast momentum eventually tires, pulling price down to this 30-minute equilibrium. This is the primary reloading zone where trend defenders catch pullbacks. Zooming out, we plot layer 3, the hourly 50 EMA, our session line in the sand. This anchor dictates structural control. If price is above it, long cohorts own the session. If below, bears control the tape. Because this layer represents massive institutional positioning, expect violent friction when reached. Finally, we anchor the matrix with layer 4, the daily 5 EMA, the macro trend anchor. We natively project the broader daily trend speed straight down onto the localized 5-minute grid. This crimson line acts like a deep ocean tide beneath your short-term execution, providing a foundational boundary of macro support. These 4 lines represent the specific battlegrounds where distinct institutional cohorts defend their timeframes. The spatial geometry of these 4 lines defines the current market state, providing a structural map that exists independently of candlestick patterns. This diagram illustrates the 3 structural market states, starting on the left with the pristine stack. This is a state of synchronized expansion. When the 4 time frames fan out in sequential order, the market's gears lock. The combined energy flows entirely in one direction. In a pristine stack, fighting the trend is mathematically futile. The operational rule is to only execute pullback reloads in the direction of the fan. But that perfect alignment eventually requires a breath, which leads us to the second structural state, the gravity snap. Looking at the center panel, we see the visual trigger for a gravity snap. The price flushes below the fast 15-minute momentum highway. When this breakdown happens, single timeframe retail traders panic. They assume the entire market structure is collapsing and flip short at the bottom of the move. The deeper layers of the matrix expose that panic as a miscalculation. The hourly and daily structural lines underneath remain completely untouched. They are still sloping upward, signaling that the macro environment is secure. The gravity snap is a temporary unbalancing. It baits short sellers into a liquidity sweep before slingshotting back in the macro trend's direction. However, if those lower structural levels fail to hold, we cascade into the third, most dangerous market state, the mixed stack. Moving to the third panel, geometric order completely collapses. The four velocity layers cross over each other, twisting into a horizontal knotted braid. Inside this knot, price action becomes erratic, slicing back and forth through the middle of the braided lines. Failing to identify this transition into a mixed stack often leads to rapid capital depletion as traders attempt to force trends into a non-directional tape. To understand why the mixed blender destroys capital, we have to look at the conflicting tape physics operating underneath the surface. Fast attack 15-minute algorithms short the tape, trying to flush the market lower. Simultaneously, hourly and daily institutional desks are heavily buying the floor. The gears are grinding against each other. The market has immense kinetic energy, but its net directional vector has dropped to zero. This chart shows the psychological torture this creates. The crossed lines generate completely contradictory signals. The 15-minute layer flashes a buy signal, while the hourly layer forces a sell signal on the very next candle. The retail trader constantly chases these false signals. They buy the breakout at the top and short the breakdown at the bottom, serving as exit liquidity for the larger desks. Technically, the market is trapped in an inventory rebalancing cycle. It functions as a compression cage, locking price in a horizontal trap until inventory is cleared. There is a specific professional protocol for navigating this environment to preserve your capital. When the matrix is knotted, the environment dictates staying entirely in cash. The alpha play is active non-participation. You sit on your hands and protect your capital while other participants chop themselves to pieces in the noise. The mixed blender state is temporary. As price continues to oscillate inside the cage, structural pressure builds inside the knot. Eventually, one time frame will overpower the others, absorb the remaining liquidity, and shatter the compression cage. This chart tracks the exact moment of resolution. The dense knot breaks outward, the moving averages untangle and expand, and price escapes as sequential order is restored. This transition, the uncoil, is your confirmation that directional velocity has returned to the tape. The trader who spent the session fighting the knot is financially depleted and emotionally exhausted. The trader who stayed in cash is fully capitalized and ready to strike the expansion with size. True mastery is the discipline to step aside during the chop, preserving your capital until multi-time frame synchronization mathematically aligns in your favor.